Hello, welcome to my midweek review. We're looking at oil and the ECB decision today. So without further ado, let's begin. We're going to start off by looking at oil and international relations behind the oil dynamics, in particular supply. And we're going to ask the question, has oil supply balanced? And in the opinion of OPEC, it has started to balance out. They argue that the Americans can no longer keep pumping and that they will be the ones to lose the battle. Here we have a diagram of the weekly oil production, in which I have set the first day of trading of the year. So this is the first trading day of 2015, the blue one, and the orange one's 2013. And it just basically plots the change per week in the oil production starting from a neutral point, and basically ignores the real price, real production, so that we can just have simply the rate of change. What we can see is that through most of 2015, the Americans have been pumping at a similar rate to that of 2013. And it has only started to diverge in recent times, since August, since the start of September. August kind of times. Seen it diverge, and particularly in September. That was when it was at its largest point, and so on and so forth. But we saw the rate of change go above in 2015, above 2013 in June. So if the question is, have the Americans got the message? By this chart, not really. And I mean, this can be really shown if we take a look at the oil price, which we will do so now. This is the oil price. This is just eToro's oil. And if we look at the first day of the trading day of the new year of 2015, we can see that we're here, and that is about 52. This is the first day. And we've been moving sideways pretty much ever since we went up a bit. There's a bit of a bull run here, and I mean, this looks like quite impressive, but I mean, if you look at relative to that, then it's not very. So we can fairly say we've been going sideways almost. But around 52, which is the really important statistic that we're looking at. But if we go over to 2013, what we can see is that basically the price level was much higher at the start of the year. Around 92, and it moved pretty much sideways very similarly, but by October had risen hugely. Now, general economics would suggest that as the price rises, you produce more. It's for any logical reasons, because you can earn more money off that oil. But the Americans seem just to be doing the same rate of change in 2000 and 2015. So what we can see, and what one can argue, is that the American companies do not seem too bothered about the price level. They are increasing production at a similar rate to protect their market share, despite the price of black gold. I mean, and why are they keeping up production? Why are they going into this long, lengthy battle? And I mean, that's quite a big question. It's a whole can of worms, but you can argue that the Americans are quite headstrong about these things. Quite a lot of heritage from their oil trading and the oil trade, and so on. Maybe iconized by the film There Will Be Blood. But to use the metaphor to describe this paradigm, it's not that dissimilar to trench warfare. Thereby, where the two nations, such as like OPEC and the American companies, not that American companies are a nation, but the two integers, they're battling it out. They're taking hits to their balance sheets and revenue, so as not to lose their ground or market share to OPEC. However, yesterday, the ratings agency Moody weighed into the debate, arguing that it would be the sovereign nations of OPEC that would be the one to feel the fallout. To take the example of Saudi Arabia, it has used its oil revenues to appease the population. However, without mass royal revenue that oil gives nations such as Saudi Arabia, these nations may struggle to keep their populations content due to the possibility that they do not make a budget surplus. What this is basically arguing is that Saudi Arabia has invested quite a lot in public services such as healthcare, infrastructure, to raise the standard living of its populace so as to keep it happy, keep it content with their lives. Now the question is, well, if it can do this, is the Saudi Arabian regime stable? That's a big question. And what this really comes back to is the metaphor of trench warfare, whereby each side is in a position of stalemate, waiting for the other to weaken enough for the other to push forward and take market share. This is seen in a technical way through the tight price action that has been going on since the 30th of the 8th to today here. So, they're in a bit of a stalemate. They keep pumping, and there's no direction. Like, everyone knows there's a lot of supply in the markets, and this supply isn't going anywhere. So we've got a real glut going on. It's bottoming out. And I mean, the possibility, the direction, is that if America keep pumping, and then OPEC say, we're going to pump even more, and we could get downwards. We could go back to this kind of trend line here, support. And we could get, but which one's going to budge first? And if either budge, then we could get some support for the oil price and come back up here. But at the moment, it ain't looking like either of them are going to be budging anyway. But this brings me on to this week. There's been another variable that has been thrown into the mix and has become fairly vocal this week, and that is Iran. It has been the case that Iran has had its sanctions for oil exporting lifted in what has been denoted as the post-sanction era for Iran. This at first seemed like it would be negative for the oil prices due to the high amount of supply that will be in the markets. However, Iran seems to be paying back the US for lifting its sanctions, with Iran stating that it will lobby OPEC to return to OPEC quotas to tighten the supply, thereby increasing the price level for oil. However, this is something of an Adam Smith United benefit. This is that Iran has its own personal agenda, being that it wants to appear as a safe haven in an otherwise turbulent region. To appear as such, it needs a strong oil price so that it can finance investment in infrastructure, protect private property, as well as keeping their armed forces strong. So to protect private property, they need money so they can enforce rules and regulations such as police force, so that it's safe, so you can put your money in and you're going to get it back. Ignoring capital gains, no one's going to come and just pinch it off you, so to speak. Or if you build an oil well as such, then you're not going to get someone from ISIS coming along and blow it up, which is why the armed forces need to be strong. So all in all, watch Iran as its actions could help support the oil price. The next meeting of OPEC is on the 4th of December, so watch how Iran, as well as other nations, position themselves leading into this meeting. In particular, to see if OPEC nations, such as Saudi Arabia, change their rhetoric of America will be pumped out first, as this will provide strong support for the oil price. So we now turn over to Europe, and we're looking at the ECB. So we're going to start with a bit of context to the up and coming ECB meeting. The ECB currently has a deposit facility at negative 0.2%. The deposit facility is the bank account for European banks such as Deutsche. It is currently, banks are having to pay to keep money with the central bank through the 0.2% deposit facility. This is to stimulate banks to loan money out, i.e. they can either loan it out and get return from the loan, or they can keep it safe with the central bank, but they have to pay to keep it safe. And this is quite an unprecedented thing when it first happened. Never really happened before in history, so it's quite big. And the ECB has also embarked on a program of quantitative easing at 60 billion euros a month. Now, to turn to the fundamentals leading into the decision, the main fundamental one needs to be aware of when considering what will be the path taken by the ECB is the inflation rate, which fell for September by minus 0.1%. Another key fundamental is the unemployment rate. This remains high in the euro area as a whole, with it at 11%. This is that 1 in 10 people are out of work. So the question is, will the ECB do more to help the situation, to get inflation back into the market and get unemployment down? And a good guide to see if they're going to act is a survey carried out by the ECB and published yesterday. It showed that QE was having some beneficial effects on the real economy. We must remember that the main aim of QE is to increase demand through increasing demand for credit, such as consumer loans. The survey found that in Q3, credit standards fell for enterprises, with demand for credit also rising from this group. What this means is credit standards are basically the standards you need to meet to get a loan. So by credit standards falling, it means that someone who's a bit more risky, maybe doesn't have such good job security, or maybe is not great at paying back loans historically, it can more easily get a loan at the moment than it could relative to Q2, with there also being rising demand. So people want these loans as well. It's not just that they can get them, they want them. House purchases, which covers loans, mortgages really, so you get more mortgage to buy a house, and the credit standards in this area have become tighter, basically meaning it's more difficult to raise capital to buy your home, with demand also falling. So there's been a joint drop there. And now consumer credit standards have become looser, i.e. it is easier to get loans with consumers goods such as a new sofa, with the demand also falling for this form of loan. So overall, it's a bit of a mixed bag of data. Commentators have noted that although the data shows an improvement, it is not drastic nor marked. So where does this leave the ECB? It leaves them in a paradigm of 4 main choices for action. This is that there is 4 main ways they can act. They can either walk through the door, open it further, pull it to, or close it. My expectation is for them to open it further. This means that they could hint at the possibility of increasing the size of the QE program or even the lowering of interest rates, with the potential for dovish tones from Mario Draghi, the head of the ECB, in the press conference after the ECB release. This would lead to a rise in equities, weaker euro. And just to give you an example of what Mario Draghi could say to lead to a rise in equities and a weaker euro, would be something like, we are maybe concerned about the level of inflation and watching it closely to see if we need to act. That's what I feel is the most likely to happen, especially with the fundamentals, the mixed bag of the recent survey. So, yeah. The other option, the option of pull the door to, is that it could pose that it does not need to do more at the moment and everything is running smoothly. Although, in my opinion, this would seem a bit distant from reality, thus may cause fear amongst investors, leading to weaker equities and stronger euro. Yeah, and the stronger euro is an interesting one. Although central banks can't openly manipulate their exchange rate, it has to be a consideration within their thinking, because a stronger euro would hurt exports, which is an input to the economy. So exporting brings money into your economy, and it makes the price of imports cheaper. Thus money will leave your economy by importing too much. So they have to bear it in mind, which is why that one's less likely. And a third option, which is walk through the door, implies them actually acting, i.e. cutting the interest rate or raising the QE program. This would really move the markets. Equities would be strongly up and the euro would be strongly down. The fourth and final option is close the door. This would be to raise interest rates or cut the QE program. This is the least likely scenario and could cause some big sell-off in equities and a strong rise in the euro, which could threaten the stability of the European economy, making it the least likely scenario. It'd threaten it because, particularly the euro and what I said about exports and imports, and really damaging equities, which they're an interesting buy, I think, but they're not strong at the moment. They have the potential to become strong, but yeah. And I mean, let's look at how to interpret what is happening during the release, preview to the release, and after. Your main way is to look at the euro dollar, and this is the reason you look at the euro dollar is because currencies are incredibly driven by interest rate differentials. So you get roll or carry or yield even from buying higher interest rate currencies, which is currently the dollar in the euro dollar scenario. Which means if you do more quantitative easing, you do more you lower interest rates as such, it becomes cheaper to fund your dollar trade. So that could lead to a sell-off, and that would be a good guide to see what's happening, especially if there's no other major variables going on. That would be the main focus, so you can see what's happening, what's going on and all that. So watch that. And if you're looking at equities, I think the best play is on the DAX. Now the reason the DAX is a good play is because it's a lot cheaper than a lot of other equity indices. So this is the DAX here, and this is a 75 simple mean, and this is a Bollinger Band, one standard deviation away, so it's a relative pricing tool. So if you look at it here, we're down here, and then if we look at something like the France 40, so that's on an hour chart. If I just flick that back up to the daily so we can compare, it's up here, it's down here, so you can see the difference. We're up here and the DAX was somewhere down here. If we just go back on the DAX, we can see that better, down here even. So it's probably about that, which is quite a big difference. You can also see this on the ESP 35 or Spaniel, this Spanish index, which is down here, and the DAX is just about here probably. So it's still different. It has some catching up to do, and it's lower because of the VW scandal. That's held it down, as well as China hurt it with its poor trade data that came out last week. It showed weaker imports and exports, and China imports is a net importer, from Germany. So that kind of hurt it. Is it going to be stable and that, and so on and so forth. So that'll be an interesting play. So just to wrap up, watch the euro dollar during the release, just to see what's happening up to and after. In my opinion, the DAX is the good play, but if it does actually happen, France 40 would be good as well. Even the Spaniel 35, it's up to your own analysis and everything. But I mean, that kind of wraps it up for today and everything. Thank you for watching. Have a good evening or morning, depending on where you are in the world. And if you have any questions, comments, please leave a comment in the comments section. And I hope everything goes well tomorrow or today for your trading and everything. And thank you. Bye bye.